So warm welcome to our listeners, new and returning. I'm Brian Ropp, Senior Director in the Financial Institutions Group at KBRA, and joining me today is John Rempe, a Director at KBRA, also in the Financial Institutions team. We appreciate that you're taking the time to hear our key points from the second quarter bank earnings. If we were to title this podcast, it would be something along the lines of "Record Earnings Are Not What They Appear to Be." So John, thank you for joining the Bank Compendium podcast this quarter. I'll lead off the discussion with the fact that our coverage universe had their two highest levels of profits in the first and the second quarter of this year, based on the median return on assets going back to our first compendium back in fourth quarter of 2015. However, there is definitely more to the story, and John and I will dig a little deeper to outline what is really driving the industry's record earnings. Before we do that, I just want to highlight that all the ratios and metrics that John and I will quote, unless otherwise noted, are from KBRA's compendium, which represents the public banks that we rate. Now, let's jump into the key points from KBRA's second quarter bank earnings, as we know that's what our listeners are here for.
Yeah, thanks for the intro, Brian. This is John Rempe. Really looking forward to being a part of this quarter's Bank Compendium podcast. So yeah, the 5 key points in bank credit for the second quarter were as follows. First, we got reserve releases, and how these reserve releases drove record earnings for the quarter, and not necessarily core banking fundamentals or a steepening yield curve. Secondly, excess liquidity, and how this excess liquidity is weighing on net interest margins, but PPP fees have somewhat helped mask the declines in net interest income and margins. Third, we have weak loan growth, and how PPP forgiveness and stimulus-funded liquidity continue to drive loan runoff with limited loan demand to rebuild the bank's asset base. Fourth, mortgage banking's impact on non-interest income. Obviously, the low rate environment has been conducive for mortgage banking production since the Fed's rate cuts, and this has helped support the soft spread-based revenues. But with that said, mortgage banking is coming back to earth. Then lastly, operating cost reductions. The various cost savings initiatives and lower operating expenses have helped offset these aforementioned weaker revenues.
So John, these are all very interesting key points. The headline earnings for many banks this quarter mentioned record earnings or record first half earnings, but they rarely focused on the items you highlight until you got to the Q&A part of the calls. So let's break these 5 items down and discuss what they mean for the credit profiles of our banks going forward. How about you take the first one, reserve releases?
Yeah, sure, Brian. I'd be happy to. So if we rewind and go back to when we first started compiling compendium stats, the median ROA for both the first quarter of 2021 and second quarter of 2021 were the highest on record for our bank coverage. And interesting enough, the first quarter of 2020 and second quarter of 2020 were the lowest median ROA ever recorded. But this does exclude the fourth quarter of 2017, which was obviously impacted by the Tax Cut and Jobs Act and the large DTA write-downs. So given the volatility with earnings in a post-CECL world, we have been focused on pre-tax, pre-provision net revenue, which reflects the true earnings capacity in our view, sort of isolating out the volatility with provision expenses and recaptures. And when we look at the PPNR relative to average assets, or PPNR ROA, for the second quarter of 2021, it actually declined 12 basis points compared to pre-pandemic or 2019. So despite record levels of reported ROA in recent quarters, the true earnings capacity has trended slightly lower. In our view, PPNR ROA is the better metric to gauge the true earnings power post-CECL and post-pandemic. And another factor to the weaker core earnings and lower PPNR has been the excess liquidity. Brian, you want to touch on that one next?
Thanks, John. Yes, excess liquidity. It's been a catch-22 for much of the banking industry since the Fed lowered rates the additional 150 basis points back in March of 2020 to combat the pandemic. So as you know, we've experienced unprecedented stimulus injected into the economy by the federal government to the tune of almost 30% of GDP compressed over just 1 year. The stimulus has created significant liquidity throughout the banking industry, driving loan runoff and significantly higher deposit balances. So if you add to the mix a lukewarm loan demand picture you get a median loan to deposit ratio of 75% for our compendium banks. That's down from 95% pre-stimulus at the end of the fourth quarter of 2019. So the downside is that banks have limited options to invest this liquidity except for earning assets with relatively low yields to replace their higher yielding asset runoff. KBRA compendium banks increased investments as reflected in investment securities to total assets to 17% at the end of the second quarter. That's up 3% from the fourth quarter of 2019. Also, the excess liquidity is weighed on net interest margins, coupled with most of the 2020 loan originations coming from the PPP program at very low rates. And we're now seeing round 1 and round 2 phases in forgiveness mode. The median net interest margin for KBRA has declined 40 basis points from the pre-Fed cuts to the second quarter of this year. The upside to the excess liquidity has been the significant decline in cost of funding, especially the cost of deposits, which has declined from 1.06% pre-pandemic in the third quarter of 2019 prior to the first Fed cut to 22 basis points in the second quarter of this year. This has perversely benefited the weaker funded banks the most, as their higher pre-Fed cut funding costs provided more room to decline in the zero interest rate policy world. However, the 6 quarters post-Fed cut, most banks have reaped the benefits as they reach a natural floor for their funding costs. So for core earnings to stabilize and improve, the banking industry will need a steeper yield curve, especially in the short end, the 1 to 5 years, as well as underlying loan demand. Speaking of loan demand, we've seen weak loan growth as the industry's stagnant loan growth since the pandemic is reflected in the significant decline since the fourth quarter pre-pandemic and the loan to deposit ratio, as well as the impact of liquidity fueled loan runoff and PPP balances being forgiven. So banks' higher deposit balances and investment securities sets up the industry quite well for loan demand once it does materialize. Anecdotally, many banks shared that their loan runoff ex-PPP and their line utilization has stabilized, which would be the key first step towards underlying loan growth. A ramification of current stagnant loan growth is pushing more excess liquidity into the investment securities portfolio at historically low rates. So KBRA expects to see higher AOCI amounts and more securities being moved to held for investment when interest rates ultimately rise. So John, why don't you take the last 2 key points?
Yeah, of course, Brian. As noted, the record levels of mortgage banking production and elevated gain on sale margins have helped offset some of the provision expenses taken in 2020 as the industry pulled forward the reserve build. However, in the second quarter, we saw a return to earth or more normalized level of production for the refi and purchase volumes, though these were still slightly higher than pre-pandemic levels. Relatively lower volumes compared to the peak and the decline in gain on sale margins dampened mortgage banking income, though these mortgage banking income levels are still healthy in our view. With that said, KBRA expects mortgage banking to continue to provide solid earnings while housing demand remains strong, which should help support non-interest income and provide some revenue stability. In reflecting the normalization, non-interest income levels trended lower for the KBRA rated universe when looking at fee income relative to average assets. With that said, total assets are somewhat skewed by the inflated balance sheets from excess liquidity. So in factoring out liquidity and PPP, the trends are relatively stable and bodes well for the industry as less volatile sources of non-interest income, like interchange and deposit service charges, rebound and continue to contribute more moving forward. Then lastly, we have operating costs. They have been on the decline relative to average assets and is helping offset the aforementioned revenue declines and results in improving operating efficiency. Many banks have followed the classic playbook of reducing operating costs in the face of declining revenues. A large number of KBRA-rated banks have taken advantage of the customer base's acceptance of online and digital banking trends and consolidated parts of their physical branch footprint. When looking at non-interest expense to average assets, it has declined significantly since pre-pandemic, down 45 basis points to 2.07% as of the second quarter 2021. Once again, the excess liquidity in PPP somewhat overstates the improvement, but overall, the trend is still positive for operating costs. And while improving efficiency is a never-ending process, KBRA expects that the large improvements through branch rationalization has been predominantly realized, and we do not really expect significant future cost saves short of any material consolidation.
And there you have it. The key takeaway from the second quarter earnings is that the headline may read record earnings, but the underlying core fundamentals are not as strong, and KBRA expects some further headwinds going forward. So let's recap the 5 key points from the second quarter's compendium. 1. Reserve releases are driving record first half 2021 earnings following the pandemic. CECL triggered record reserve builds in the first half of last year. CECL and economic forecasts will continue to create earnings volatility going forward. Excess liquidity fueled by the government stimulus programs continue to weigh on margins, combined with the zero interest rate policy pressuring net interest income. Third, weak loan demand is hampering the industry's ability to respond to lower margins. Fourth, mortgage banking income has helped non-interest income offset the pressures from declining spread revenue, but the housing market is stabilizing and other components of non-interest income will need to, quote, step up to boost non-interest income going forward. And then lastly, the industry has cut operating expenses to help offset revenue declines, but the low-hanging fruit has been harvested. So KBRA doesn't expect significant reductions in operating expenses as a percent of average assets to boost future earnings. So all in all, we do expect some continued headwinds for the bank's profitability going forward without meaningful loan growth. However, KBRA continues to view the industry's core capital and earnings profile as solid, and we believe the industry is well positioned to address the challenges of excess liquidity and the low interest rate environment going forward. Well, listeners, we appreciate the opportunity to share our insights from the second quarter Bank Compendium podcast, and we hope you found it to be useful. And John, thank you again for authoring the compendium summary for this quarter and for joining the podcast. We look forward to speaking with you next quarter, and have a great day.